Hey, welcome. This is the Investor Coaching Show. Paul Winkler, along with Ira Work and Evan Barnard, hanging out here talking about the world of money and investing and whatever else happens to
pop up.
Like weather balloon, or weather balloons or whatever that
down.
thing is. Like Chinese balloons. Whatever goes up, pops up. No, whatever. And then comes down. It's like what goes up must come down.
There you go.
Yes, that is kind of the top. You know, you look out there at all the news, and that's it. You know,
Right.
everything, that's all anybody can seem to talk about right now.
Well, you know, there's really only one thing really ever happening at a time. Like right now, it's the balloon.
Well, yeah, not necessarily one thing happening at a time, but only one thing that seems to be really interesting to people. My son, you know,
Or
we
important
talked
to
about this
report
last
on.
night. My son was, you know, a little bit anxious about it. Going, you know, it's just, I said, yeah, you know, something good's going to come out of it. And he goes, how do you always think that way? I just know it's rational. Something is good just around the corner. I just have this feeling.
I see the image of that balloon in a future presentation about why we don't time the market or something like that.
Is that not so true? Evan, is that not just dead
Who
on
was
right?
forecasting a spy balloon going across the country?
Oh, everybody knew that was going to happen.
Well, I don't know that anybody can actually forecast, but they probably predicted it.
There you go.
Yeah. I don't know. It was probably in a movie someplace. And you know how today we have movies and what happens is we have these things and then all of a sudden it happens in real life. Hey, that's a great idea. Let's fly an airplane into, you know, because there was a movie about that apparently.
Oh, yeah.
Before that happened,
Yeah.
before 9/11 happened. I didn't even realize that.
I am
That-
still waiting to be able to beam myself from the house into the office.
I
That's what I'm
am-
shooting for.
Well, that's what I'm looking for.
I'm going to second that emotion.
I would invest in that technology in a second.
That
I hope I live
be
long.
our luck, though. My arm would be back where my leg was.
Yeah.
You
I was
know,
gonna
you know
say,
how it
Evan,
puts
you
it
go
back
first.
together. You wouldn't get put back together properly.
I'm just really waiting more for the flying car.
There you go.
I don't have
It's
to be
there,
beamed
Ira.
anywhere.
It's there. It's
No.
there. It's. They've already have them.
It's not in my driveway.
10,000 hours on that black fly. I've told you that.
It's not in my driveway.
More than 10,000 hours now.
I'd buy that before I bought an electric
All right,
car.
so stock markets are responding to other things that are other than interest rates. Yay! Should we be excited about that? Or more excited about a professor that... No, we're not going to go there. Okay, you're like going, what is he talking about, a professor? And then Evan's laughing. You know, there are times, and I won't use names, I'm not going to get into it, but you know, there are some... Sometimes I'm really big into academic research on investing. I think academic research is absolutely critical. We have to have people outside of the investment industry giving us information about investing.
Yes.
You know, so as to not end up with information that is biased toward getting us to buy products. And one of the things that drives me crazy is when you'll see certain professors that are really into, you know, talking about products and giving information and doing research on products that you know full well that their college is bought and paid for by insurance industry.
Yeah.
And that's, you know, when you see a retirement for like that, it just makes me happy.
Yeah, it's kind of like, you know, it's like making an assumption about the outcome. And then, you know, I mean, it's all selection bias, a lot of it, and or confirmation bias.
Yeah, confirmation
and just,
bias, sure. You'll
I
find
know
what
the
you're looking
solution
for.
I'm looking for, and so I'm just going to craft the problem or craft the research so that I come up with the answer. Kind of like a lot of these political polls, frankly, is,
Yeah.
you know, what answer would you like me to get you? That's how I'll design the poll.
Yeah, I'll design the question.
Right.
And you can do that. You can ask the question, and it'll be in such a way that you'll get the answer pretty much exactly what you want or something similar. But one of the things that has been happening recently in markets is everybody's sitting around watching, what's the Fed going to say? Where it's going to go? Where are interest rates going to go? And, I get Fed fatigue for sure. Get sick and tired of watching, hey, is the market going to move up today because Powell burps or whatever. I mean, just
Right.
after a while, it gets a little tiring. So there was a good article as in, I'm glad to see this, in Wall Street Journal. It was, for markets, good news is good news again. Now, that's important because I remember watching TV in the late 90s, when you were having, everything was about the Fed. Everything is about the Fed. And, this is a very different time. You had stocks selling for 100 times earnings, 200 times earnings. And at that point in time, technology stocks were just unbelievably lofty. I mean, only in hindsight do we know that. It was because it was expected that earnings would be jumping like crazy. So let's say you have stocks selling at 100 times earnings, which historically 16 is the number. They sell for 16 times earnings. And you can look at forward earnings, backward earnings. A lot of times people mistakenly look at backward earnings, what earnings were over the last year. I would rather look at forward earnings. That's much more important to me. But you were looking at 100 times earnings. And you go, wow, that was like crazy, crazy high. And you go, well, if earnings, if they were to quadruple, and you go, well, that'd be a huge earnings growth. Well, not much of an earnings growth if you've got next to no earnings and you've got lots of expenses. If I have a tiny, tiny earnings number, in other words, really small earnings number, because I've got lots of expenses and I just have, sales that are barely covering my expenses, then of course your earnings number is going to be very low. All it takes is for sales to start to go up to a reasonable level, and you can have quadrupling earnings is nothing, when you have that happen. That'd be bam, this happens just like that. Well, so in the late 90s, we weren't sure what the earnings growth rates were going to be because technology was doubling every 18 months. Productivity, we had incredible increases in productivity. And if that continued on the same trajectory, we were going to have great earnings growth. Well, what happened was that didn't happen, and that's where stocks came tumbling down. Well, we haven't had, but we did the other day. We did have an announcement that our productivity exceeded what we expected. And I was like, yes, that's really important. When productivity gains start to come in and they start to exceed what we expect, that overcomes some of the increases in cost of employment. So if you have labor costs going up, but you have productivity increasing, you're getting more stuff out of the same number of people.
Right.
That's important. And that's basically what they said. They talked about that happening. So what's happening now is we're starting to see good news being good news again in the stock market. So hence what that means is that we're not just looking at because what was happening before is we were looking at inflation. Are we going to increase interest rates? And the reason that was so front and center is we wanted the economy to go down. Who on earth sits around and says, man, I just really love for the economy to go backwards. This would be just great.
Sure could use a lot of bad news today.
Yeah, well, but Evan, it just reminded me so much of the late 90s because that's what the story was.
When you were talking about the 90s and, now good news being good news.
Yeah.
That was kind of when Amazon had first come on the scene.
Yes, I remember.
And
yeah,
I would just scratch my head that this quarterly report would come out. Well, we've lost another $160 million, and the stock goes up another 3%.
We thought we were going to lose 180.
Oh, it's going to go up another. That was one of the really just bizarre things to follow early on.
It really is. I mean, and that's a good example. You could have a company that comes out and says, oh man, we're going to lose, $10 million or whatever. And you watch their stock go up and go, what on earth? well, we thought we were going to lose 15 million, so it's, 10 million was an improvement.
Right.
And people don't get that about the stock market. So they're watching the economy and they're going, well, the stock market's going up. Is the economy really good? And what they don't get is that's not what drives markets. Yeah, it does in a way, tangentially, but really what it does is did it do better than what was forecast? Did we have an improvement, or did we have not as good of an outcome as what was forecast? And that will drive markets, and people don't get that. So they're basically saying that, the pattern of stocks and bonds yields rising and falling in parallel held for most of this century. So if you have increases in bond yields, and you got rising and falling in parallel. What happens when these bond yields go up and the stock prices go up, or bond yields go down and stock prices go down? You'll have those parallels. They're saying until last year, and what happened is last year we started to see this worry about interest rates. Now he makes the comment that we're in the early days. Past couple of weeks, investors have begun moving away from their obsession with inflation, shifting markets into a new regime where good news on the economy again is good news for stocks. And the areas of the markets that I think that are really doing well is just so far as we talk here, it's interesting. Small companies, rocking it, micro caps. That's the big area, which is an area that most people don't have in their 401ks. Micro caps.
Sure.
Because it was Michael DeJorno and I were having this conversation off air, and we were just talking about 401k, and I said, your 401k, the thing is that with your 401k, you don't have access to a lot of these areas of the market which are doing so well or did better last year. We talk about last year, what a rough year it was. Well, it was rough mainly for just a couple of areas of the market. The areas of the market that got nailed the worst last year were, large U.S. stocks down 18%, as measured by the S&P 500.
Right.
And yet, if you look at, like, for example, value companies, well, they went down, but it was nowhere near as bad. It was down 5%. And then you had, small value stocks down 3%. Mm-hmm. So you look at that and go, wow, why did my 401k get nailed so badly? It's because value is typically measured in 3 different ways in the investing world. Number one, it's just nomenclature. When you hear say we got this value fund, and the fund company will say that they're running a value fund, and what they mean by that is we've searched out companies that are undervalued, right. and we've put them in your portfolio. That's one way that you hear about it.
Yeah.
Then you have the typical industry: price to book, price to earnings, price to sales. Those 3 right there. And, what they'll do is they'll look at all of those 3 and they'll go, well, this is a value fund because the price to earnings is low, or that the price to sales is low. The problem with that is your denominator, which is earnings or sales, can be all over the place. Hey, we had a great earnings quarter. Oh, we had a lousy earnings quarter. Hey, we had a great earnings quarter.
Right.
And it can go up and down and back and forth. Well, if that's the denominator, remember in elementary school, the down number in your fraction, if that number's fluctuating all over the place, and if it goes down, my fraction has gotten bigger because my price at the top, let's say it stays the same, all else being held equal,
yes,
as we said in math class. If the earnings goes down, now I have a high price compared to my earnings, and I look like a huge growth stock. Or if I have a boost in earnings, now I have a fraction that's smaller, and hence now it looks like I've got a value company when I don't have a value company. And if this is confusing for everybody out there, I apologize, but this is the investment industry. Confuse the living daylights out of you so you can't see your head from your tail. What I like is academics go, no, let's look at price compared to book value, which is book value or your assets of your company. Is your company selling for close to what the stuff can be sold for? Is your company, the price, is it dropping down to near what if I went and liquidated and I sold my building, my machinery, my equipment, my stuff? If it's getting down to the value of the stuff that you have in your company, then it's a value company. That's just a lot easier. Because that book value doesn't change all the time. It doesn't go up and down and up and down. It fluctuates a little bit, but not much. And that's why that's so important. Well, that area of the market last year was just, not nearly as hit hard as other areas, but a lot of people saw their 401ks. They got a little bit hit harder than they thought, but that's why. But partly what was causing all of that is this focus on interest rates. Because if interest rates are high, growth companies, which are not value companies, they're growth companies won't get their earnings for many years in the future. So since those earnings won't come in for many years, we discount them to today's dollars. In other words, we go, $1, you give me $1 10 years from now, and it's not worth nearly as much to me as $1 today, right? Well, if you tell me you're going to give me $1 10 years from now, but inflation's going to be 10%, that dollar is going to be worth just about nothing to me in 10 years.
Right. I'll take 30 cents
So
today.
hence, I'm looking at Nick to make sure he's getting this. So hence, if you tell me you're going to give me $1 a year, 10 years from now, but the inflation rate's high, what will I pay you for that dollar right now? Not much, because I'm not going to get it for 10 years, and it's going to have a purchasing power of a dime. Maybe not quite that bad, but it'll be low. So hence, if inflation is high, a growth company that won't pay its earnings for a while will be worth less. Hence, that is your explanation for why large growth stocks and why most company 401k plans went down so much last year, because that's what they focus on. Right. That's what happened. You were basically buying companies that didn't have necessarily the value component, which is they were basically in value companies. A lot of them, let me explain this quickly. Value companies a lot of them are called stodgy companies. They got earnings and earnings and earnings and earnings. They're boring. And hence, they don't have a lot of earnings that will come in 10 years from now. They've got earnings that are coming in every year because they sell toilet paper. And they sell, right? They sell gas. They sell stuff that we continually need.
Right. Yeah, and to me, there's a couple of pieces that jump out from that conversation. Number one...
Well, you want to hold it until after a break?
I would love to.
Let's do it. All right, back here on the Investor Coaching Show. Paul Winkler, Evan Barnard, and Ira Work. Talking money and investing. Okay, so we were just talking about how the stock markets are looking at different things right now. For a while, it just seemed like the only thing that mattered was what the interest rates were going to be, what Fed policy was going to be. And just commentary in the Wall Street Journal saying, hey, good news. We're actually looking at something other. We're actually looking at profits, which is really what you're buying when you buy stocks. Imagine that. We're not sitting here just wringing our hands as to whether the economy is going to slow down enough to stop interest rates from rising. And it's kind of silly, but that happens once in a while.
Yes.
But anyway, Evan.
Yeah. In your conversation about value stocks, there's a couple things I wanted to expand on or even warn against. Mm-hmm. Being able to have an explanation for this is how we're looking at growth stocks, and this is why a lot of these technology companies behaved the way they did in this interest rate environment. Mm-hmm. Doesn't mean you can forecast what's going to happen. Like, this is going to be a good time to buy technology stocks because, I know interest rates are maybe going to go down. There's a difference between explaining their behavior and trying to twist that into, I can predict when it's going to happen next.
Right.
Just as a caution.
Right.
But the other thing that you think about, a lot of times technology companies, not so much like a computer firm, like a Dell or something like that, but they don't have a lot of physical assets. They're creating ones and zeros and selling ones and zeros and so forth that you download or whatever. They don't have huge plants where they're processing grain and turning it into, bread and mining equipment. And so they don't have a lot of book value to keep that denominator steady, And so, that's why when you talk about stodgy companies, they do have a lot of stuff that they're using to produce the profit.
Right. And with those tech companies, they do have assets. A lot of them aren't. They aren't brick and mortar and machinery. A lot of it's intellectual capital
property.
And those types of things. So it is a different type of deal. And then you have other types of companies altogether that make it a little bit more complicated, like banking.
Yeah.
I remember having a conversation with an academic, I think this is going back 15, 20 years ago, and saying, what is the deal? Because I was trying to get my head wrapped around this with, value companies. Some of these value companies, or these growth companies actually, look like value companies if you look at the price to book, which is really to what Evan is talking about. And you look at these things and go, they've got this really, really low price compared to, the book value, the assets. And I said, so it looks like a value company, but it's actually a growth company. And he goes, yeah, it's an accounting thing. And then he explained the accounting. I was like, oh, yeah, that's interesting. And it was probably about 5 years later, actually the research came out that, hey, we can make companies even more value-oriented, the funds even more value-oriented if we can actually exclude for profitability. And that's where the profitability analysis came from, is looking at that very problem, which was these companies looking like value companies that weren't. And that is, if you look at value portfolios, this is something that we look for. We want to make sure that the funds are actually focused on this type of data so that you don't end up with a mutual fund that doesn't behave the way it should when markets go down, which is value companies. A lot of times they don't go down as much, which sounds weird, that they don't, because you'd think, well, what's a value company, Paul? It's a distressed company. And it's more distressed, it's less growth oriented. And you would think, well, when markets go down, that should go down more. No, actually, a lot of times it doesn't go down as much. If you actually look at the history, it doesn't go down as much because the price is already depressed, number one. Sometimes it even goes up because of the nature of the type of companies. Toilet paper companies and those types of things I was joking about earlier. Right. You're going to use it even in a recession. So...
And we've maybe chewed through the inventory that was created during COVID or whatever.
Yeah, well, that's a whole other story. That's a story for another time. So, it makes it a little bit of a challenge for an investor to really figure out what's going on. Well, typically what you do is you go, I have no clue how to figure this out. You can actually look if you look online on the funds that you happen to own in your 401k. And right now, let me see. I actually have the numbers in front of you. I could tell you what the numbers are right now as we speak. If we look at value companies right now, small value companies right now as we speak are selling for about $1.10 for every dollar of book value. This is most recent data that I have. For international, it's 83 cents.
Which is up.
It's up a little, but not much. It was at 70 cents. Now it's at 83 cents. So if you look at that, it's not, but it's still below what the price is still below the assets of the company. If you look at it that way, then versus look at large U.S. stocks. When you hear U.S. market's still overvalued, you hear people saying that, right? Well, that's selling at 343. That's why they're saying that. That's still selling for $3.43 for every dollar book value. And if you look at like international value at 83 cents, you go, I can't see where you're telling me that's overvalued.
Right.
I mean, that's a pretty doggone low price. So recognize that when you hear people talking about the market, they're myopically only talking about large U.S. stocks. That is typically all anybody ever talks about. And if you look at large U.S. value companies, let's see, where's large U.S. value in this whole thing? Large U.S. value is sitting at $1.86.
I was going to say 2. Okay.
It's a little bit higher. It was down to 140.
Yeah.
Now it's at $1.86. But it's still not a really high price. But if you look at what has done, past tense, what has done well, the smaller companies, and those smaller companies have a lower price to book. So in essence, it was one of these things that I've been talking about for a while and going, hey, it's probably at some point this is going to happen, these smaller companies, because, during Trump, and when Trump was president, it was large U.S. growth all the way, large U.S. growth, large U.S. growth. I mean, literally the 4 years that he was president, large U.S. growth beat everything else. And, you just go, well, what could change this? These are the greatest companies. This sucks people in. These are the greatest companies out there. It's going to go forever. This is wonderful. Look at my 401k.
So why do you think that we don't see very much small in 401ks?
I think it's familiarity bias. Just I'm not familiar with those small companies. People have that perception that small is risky.
Well, I can understand the investor not putting the money in because of the familiarity bias. But why do we see 401k plans that don't even have small as a choice?
But it's familiarity bias still. I think that how I talk about how if you look at the Dow, the S&P 500, and the NASDAQ, large U.S. stock, that's what we hear announced in the news. And if I go start throwing small companies in there, and small companies don't perform up to the level of large U.S. companies, they perform under it, then all of a sudden my investment management looks like I don't know what I'm doing because I don't have the high return that the Dow just gave us.